today and the support the regulator's trying to do, and even obviously the Asset Commissioner this morning, I think is certainly a very positive bid tone to the market now.
I might just turn to Irene. One of the things that I guess we've been stressing is just how well Australian securitisations have performed over the crisis, and we've shown some data here. You can obviously see the prime delinquencies in Australia trending much lower than UK, for example. Maybe could you just talk a little bit about what we've been hearing from some of the international investors and what some of the issues might be around Australian structures versus foreign structures?
Sure. So from talking to the international investors, the focus is very much back on yield. We're not hearing very much on the side of credit concerns as such, which is a sign of good times. So they don't seem to be raising questions with regards to the mortgage performance, or in particular with regards to the performance of the housing market, which is always a popular topic around the housing bubble in Australia. And there are still some US investors who are very much scarred by the US RMBS experience. So they're still staying away from any sort of RMBS, but they are interested in Australian covered bond. And I guess that's sort of very much on the back of obviously Australian banks being very strong and well-rated covered bond issuers, and also the mortgage market performing really well. So the RMBS delinquencies as of August were around 1.35%. Which is, those levels would probably go back, well prior to the crisis. Also, in Australian prime RMBS structures are quite simple. There's, only 2 or 3 tranches. The principal waterfalls are clearly defined. Principal waterfalls are quite straightforward. The structures continue to be well enhanced, particularly since the crisis. We'll have obviously subordination from the junior notes, as well as mortgage insurance. And APRA is very much intent on keeping those structures simple. So in that sense, it's quite transparent for investors. They continue to compare favourably to international RMBS.
Just on that though, Irene, one of the questions we had was, you and I would have been talking 2 or 3 years ago, and all the questions are about trying to slow down the housing bubble, all those sorts of things. We were in the US a couple of weeks ago, and we had the least number of questions about the Australian property market that we've had for probably 10 years. How's the rating agency interaction with investors changed? I mean, what you're saying that people are less focused on that now, do you feel like? They're less worried about particular geographies or the property market, do you think?
Yeah, absolutely. I think people seem to be more concerned about natural disasters than the housing market. Whether it's rightly or wrongly so, we'll see. But there's certainly less concerns from the international community.
So, Andrew, I guess probably investors giving you mandates are a bit closer to all of this here in Australia. What are you hearing?
I think for investors in securitisation, it's got this great tailwind. The biggest challenge of the wealth management industry in Australia at the moment is post-retirement income. That is this sort of demographic that's moving through the Australian sort of a population of baby boomers as they go from an accumulation phase in their superannuation to a sort of spending phase at some point. And ideally, they'll be moving from growth assets to income-producing assets, so from potentially holding more equities to less equities and holding more yielding assets. And the sort of things they want to own are sort of relatively modest in terms of risk and produce income. For us, sort of product we want to offer, or the mandates we're getting asked about, are floating rate credit. And within floating rate credit, securitisation's got a natural place, and its risk profile, I think, certainly suits that end investor if the marketers are targeting that post-retiree looking for a regular check.
If I might just stay with you, Andrew, we obviously heard the latest from APRA yesterday, and some of the things that I guess I took away from that were the continued emphasis on simpler structures. We heard some more news about capital relief and skin in the game requirements. Maybe for the first time, a clear link being drawn between the longer dated funding offered by securitisation and meeting the LCR, and an acceptance that banks would be selling securities to each other. And then finally, some news on warehouses, which I guess was possibly controversial. In terms of simpler structures, maybe we start there. How does that play into your mandates? Is that something that's sort of seen as a prerequisite or just a nice to have?
Oh, I think for us, and I think for many, say, superannuation investors, the simplicity of the structure is sort of very much appealing, if not essential. I think Irene mentioned that the model Australian structure is reasonably straightforward. It doesn't have unnecessary complications, and I think that's appealing for us. And I think where sort of there are a whole lot of additional sort of apparently unnecessary enhancement, it sort of raises a flag to an investor. Do I really understand the issuer's motivation in putting all these things that seem redundant at the beginning, but for some sort of remote scenario that's potentially it diminishes an offering's attractiveness to us anyway. And I think sort of reading Charles's speech, he seems to repeat that theme a few times where unnecessary complication, going against the spirit of the legislation, but with complying with the letter. And I think for an issuer, a simple structure will continue to sort of fit within the APRA framework, within their regulatory framework, and it certainly works for investors, if not essential. Yeah.
Irene, I might just turn to you. Any obvious rating implications from what we heard yesterday?
It's probably a little early to say what it will mean for new transactions. I'm sure, as everyone else, we are looking forward to taking a look at the proposal in more detail once it's out. Certainly, taking away from some of the things that Charles has mentioned, obviously having simple structures is credit positive, although it could be a little bit boring as an analyst. Another thing Charles has mentioned is substantial skin in the game. So we're obviously yet to see what substantial means and what form it takes. But to the extent that it takes form of subordination, for example, that would mean that the senior notes could be extremely well enhanced. And obviously that's adds to rating stability. So it's a positive thing.
Simon, I've got to ask you, I guess a bit of giving with one hand and taking away with the other yesterday and some of the news that we heard. How does that play through for the regionals and I guess in particular some of the smaller institutions?
Yeah, I think that the main thing we've taken straight away, I guess, is that the regulator certainly is looking to provide a very positive tone, I guess, for the securitisation industry. We will be obviously encouraging them to speed up that phrase that he used, I think, through the course of 2014. I think we'd all like to get that into the first half of next year if we can. But from our perspective, the fact that the regulator is looking to support the product, enhance securitisation as a funding tool, he understands some of the challenges. I think there's some misconceptions within the industry about why APRA wants standardised banks like us to hold almost double the capital that we do. So if the Lewis family comes to Westpac and wants, takes out a mortgage, then that same family comes to Suncorp, then Westpac's holding, I think, roughly double, Guy, the amount of capital that you would, because we hold roughly 35% as a risk-weighted asset, and the majors are slightly less than half of that. There's a reason why APRA wants us to do that. If we want to hold less capital, there's a list called the Advanced Accreditation, and you can go through the expense and difficulty of trying to reach that. And I think that was something that was coming through to me yesterday, that's a hurdle that as an organisation we're going to have to get over, because they see the punitive capital differentiation between the majors and the regionals as a way of curtailing regional banks from lending too much. They can continue to grow, but it's at a cost that the shareholders will have to bear. So that's one big thing. Diversity obviously is a big thing. The interesting point for me was around trading in secondary markets. So, being able to, we've never really had the appetite nor been brave enough, frankly, to make a price in Apollo paper, and that's not something we're necessarily going to take, I think Antara's going to get all excited in a minute, and I'll have to be taken up on my bid. But the reality is, if there's 5, 10, 20 mil parcels that we can facilitate, then maybe that's something we would look at. We'll have to get credit sorted out, etc. And I guess, the feeling that securitisation has a very, very strong future in the industry, I think that was very important. We've been banging on for years and years now, and it's fantastic to see, people like Henry have come out from London, and Michael Rose from Standard Chartered, who you've heard from, and the level of engagement that investors are prepared to go to, and they've obviously been putting their money where their mouth is as well. 440 million of our last Apollo deal in May went offshore, out of $1 billion, 1.15 billion. So that's a meaningful chunk. We had 110 investors at the Tokyo ASF thing. I think I mentioned that yesterday. I'm assured that it had nothing to do with the crowd building as we got closer to the Penfolds tasting. But the fact is that there is real engagement in those investors and what they're interested in seeing. And the reason they're interested is because the product performs. All of our customers have a very strong sense of repaying the bills, So I think RMBS is going to continue to be a strength. But for us, again, as Guy said before, it's all about investor diversity.
Andrew, I just got to jump in there. Improved liquidity's got to be good, right?
Yeah, I think absolutely. I mean, for an investor buying sort of RMBS, I think one of the things we have to sort of get comfortable with is it's not so much the default, because we're very comfortable with the asset class and its history is long-standing, and the probability of loss is well understood. But it does have to be considered illiquid. So there's only a finite portion of the portfolio can be in something that is illiquid, because clients can come and ask for their money back at any time. So I think if a real secondary trading market was to develop, that would be positive. I mean, positive certainly for the investor community. I think we'd sort of still be realistic about how much could be bought and sold. Particularly if you're a large fund manager, it's got to be meaningful for the portfolios you run. But the idea of being able to sort of marginally reduce and marginally add to a holding, which certainly adds to the appeal of an issuer's securities, definitely.
Guy, I might just turn to you. I was interested in the sort of more or less explicit link between the long-dated tenors you can get using securitisation and sort of meeting the LCR. How did you interpret that conversation yesterday?
Yeah, I mean, the way I still interpret that conversation is clearly what